This is the Capital Market. Hello and welcome to the program. I'm Edidiong Iwang. It's the last edition of the program for the year, and we'll be reviewing the market performance, drilling into policies and regulations that benefited the market, and we'll also get an outlook for 2021. And I'm being joined by a professor of capital markets and the president of Capital Markets Academics of Nigeria, Professor Uche Uwaleke. Good evening, Professor, and happy holidays. Thank you for joining us on the program.
Thank you for joining us on the program.
Yeah, thanks, Edidion, and compliments of the season. Let me also say that I'm happy to be your guest on the last edition of your show for the year.
It's lovely to have you. It's lovely to have you as always. But let's start with your review of the capital market this year. In your view, how would you say the markets performed this year?
Well, to answer your question directly, the market weathered the storm. The market performed, relatively well. As you know, even in this period of downturn, not all sectors have been, severely hit. I would say the capital market, particularly the stock market, has been one of the bright spots of this year. As you know, the market started on a positive note in January. In January, we had a positive performance. But in February, when the announcement came, late February, the index case was announced. The market went down. The worst performance of the stock market this year has been in March, when the market year-to-date return was down by as much as 18%. That has been the worst. And that's on the back of COVID. So this year, generally, aside from the February, March, and the also slight drop we saw in June, the performance has been, if you like, quite superlative. Superlative amidst the COVID, superlative amidst the economic recession. Why, some have said that the performance appear to be disconnected, from, the performance of the real economy. So I would say, by and large, the market has done well. As we speak, we are talking about year-to-date return of close to 40%. 40%. And if you compare that with what obtains elsewhere, I think it's one of the best in the world. As far as I can see, I was looking at the Morgan Stanley Capital International World Index, as well as that for emerging economies. If you look at that, emerging economies, for example, tracks about 26 emerging market index, and the year-to-date return is just roughly 11%. That of the world for developed markets is about the same. So for our markets to be returning something close to 40%, I think that's quite commendable. And Edidion, why that has been so. Favorable policies, particularly from the monetary authorities, have helped that because these policies have engendered a low-yield environment and, of course, made investment in equities in particular, quite attractive. So the stock market has been vibrant. Permit, if you like, you can use the word bullish, especially in recent times. The best performance we saw in November, when the Asia index gained as much as 14%. In October, it was 13%. So apart from the 3 months I mentioned, every other month has been positive. The bond segment, of course, the government has been dominating. The bond segment, so you could say, has been active, particularly in the primary segment of the bonds market. The government has done a lot of borrowings this year. We've seen FGN bonds, we've seen savings bonds. And by extension, you could also say, given the fact that each time the government comes to the market to borrow, is usually oversubscribed. So you will also say the appetite, investors' appetite for government securities, has also been high. So overall, I would say the capital market has done well. And this is confirmed again by the MBS figures. The MBS figure tells us that the financial sector, in spite of the recession that we are in, has been able to stand above the waters. Financial sector alongside the telecom sector. So the combined effect of low yield environment, the fact again that in terms of participation, domestic investors are playing more now than it used to be, especially institutional investors, because they tend to have a longer term view of the economy. So I would say in terms of relative stability in certain indices, these institutional investors are showing some confidence in the economy, and that's why they have been investing. If you remember, last year, apart from 3 months again last year, foreign investors held sway. But this year we've seen a lot of domestic investors playing active roles. Now I had said the market returned close to 40%. That's when you're looking at even the average performance. Because if you take some specific stocks, some specific stocks have actually outperformed the market. Some of them returning as high as 80%, for the year. If you take stocks like, especially the high cap stocks, if you take stocks like Dangote Cement, for example, trading at nearly 52-week high, 209 naira, or MTN at 160 naira, these were stocks that were quite, down only a few months ago. At one point, MTN was as low as, if you look at the 52-week record, was as low as the 19 naira, the price at which it came to the market in the first instance. But today we are talking about 160. Ditto for Dangote Cement. Zenith Bank, GT, the high cap stocks, as I said, have done relatively well. If you also go to the main board and you pick some of the health stocks, Niemet, for example, has also done well. In the agri sector, Presco and Okomo Oil, have also returned, returns that are well in excess of the average. That's the all share index. So overall, the capital market has done well, and that's also helped by the fact that over time, there appear to be relative stability in oil price, because oil price also dictates what happens in our market, particularly when foreign investors are around. But as I said earlier on, domestic investors are the ones driving the market now. So the fact that oil price has also stabilized above $40 per barrel on the average, the fact that again, largely until recently, COVID-19 cases also were on the downward trend. So if you take all this together, it's easy to see why the stock markets and indeed the capital market performed relatively well.
Well, Prof, earlier you mentioned some of the market policies. Now, I'd just like to get your assessment of these policies and regulations that we saw, put in place this year. And what policies would you say benefited the market the most?
Yes, if you look at monetary and fiscal policies this year, they've tended to be expansionary. On the fiscal side, we've seen government government spending rising again as a result of COVID. As you know, as one of the response, as part of the response measures, the government injected a lot of money into the economy. And on the monetary side, in particular, it also was expansionary. The central bank, pulled back from its contractionary monetary policy. We saw, for example, the monetary policy rate being reduced from about 13.5% in May to 11.5% by September. We also witnessed a number of actions by the central bank that tended to also increase liquidity, which also brought down interest rates. The loan-to-deposit ratio of the central bank, 65% loan-to-deposit ratio, is also one that ensured that a lot of credit went to the real sector. And the raft of interventions the central bank had, including the reduction in interest rates from 9% to 5%, talking about interest rate on CBN's interventions, the moratorium, one-year moratorium granted banks, allowing them, to restructure loans. So a number of measures the central bank, unveiled, including that of the fiscal authorities, helped to lower interest rates. And then, as I said earlier on, they also made investment in stocks quite attractive. And you also notice again that when an investor considers investing in a particular asset, and the investor is thinking or is also looking at the inflation component of that investment. So after adjusting for inflation, if whatever you're going to get is will be negative return, of course you don't want to invest in assets that will give you a really positive return, and that is why the equities market, have also appeared quite attractive. Inflation rate has been quite high, and it's only in the equities market now that you will tend to get returns that are in excess of the inflation rate. We have seen how, again, part of the central bank's policies have helped to crash rates in the money market. Treasury bill rates are quite low. Even the rates on fixed income, generally, including bonds. So investors, preference now shifted to equity. So that's quite natural. And on the part of the regulators, I would also say the regulators, in a way, to help to boost confidence in the markets. Remember when this COVID came, I recall that the SEC, released a number of circulars. In March, for example, the SEC released a circular that allowed for the filing of applications electronically. The same circular also said companies could also submit their returns electronically. The Nigerian Stock Exchange did the same, supported that, reinforced that by also allowing companies to file returns. There were also guidelines and advisories on how companies, should conduct their meetings, particularly annual general meetings. So these efforts by regulators, the policies by the central bank, and the interventions by the fiscal authorities all combined to ensure that at least and that was also why the contraction we had in the economy in Q2 of 2020 was not as high as people had predicted, 6.10%. And by the third quarter, that contraction had reduced to 3.6%. So if you take all that into consideration, it goes to show that there is light at the end of the tunnel, and so investors, respond to that kind of news. The market is about news, favorable
Prof, we'll
news.
we'll just hold on 1 second. Please just hold your thoughts, and we'll continue this conversation when we return in a moment. Please stay with us. Welcome back and thanks for staying with us on the program. Professor Uche Uwaleke, a professor of capital markets and the president of Capital Market Academics of Nigeria, is still with us on the program. Now, Prof, just before we went on that break, you spoke about inflation and, how investors can, model through all of that. But looking away from investors now, Nigeria is currently in a recession. Like we all said, inflation is off the charts. How should the average Nigerian weather the storm, especially as we're going into a new year?
Well, this year has been quite difficult for the average Nigerian in the sense that if you look at the twin challenge that the economy is facing at the moment, not just that of recession, downturn in economic activities, but at the same time, that of rising inflation. So a situation where you have rising cost of goods and services, particularly food, because the inflationary pressure is coming more from the food. The ordinary Nigerian goes to the market and is unable to buy what he used to buy before because of inflation. Purchasing power has diminished. Of course, that's going to be difficult for the ordinary Nigerian, not just for the individual, but even for firms that are also sourcing raw materials for production. So generally, it's been a difficult year, and the way to go, how to weather the storm, to borrow your words, would be to the government has a lot of roles to play, and that role should begin, in my view, with tackling the issue of food, because I think adopting that approach would be like having a saver bullet. You use one bullet to kill two birds. You use one stone to kill two birds. And what are the two birds? You're addressing the issue of recession. You're also addressing the issue of inflation, because what is obvious now, even the central bank has confirmed it, is that the inflation we are experiencing is not caused by monetary factors. It's not something the central bank can actually control using the traditional monetary policy tools. It's more of structural bottlenecks coming from, again, insecurity. Insecurity is making it difficult for farmers to go to farms and produce. So that's why I said the government has a lot of roles to play. That role should begin begin with tackling insecurity, and also implementing, aggressively the agric component of the economic sustainability plan. If you look at the plan the government has on agriculture, that plan is wonderful, but implementation of that plan is the challenge. So if that plan can be implemented, okay, mass agriculture, getting in between 20,000 to 100,000 hectares of land in every state, okay, and putting in more money in agriculture, I think that will go a long way in addressing the issue of food security. So when food prices come down, especially now that the borders are being opened, okay, so I expect the reopening of the borders, to rub off positively on to moderate the inflationary pressure. So if food prices come down, I think inflation rates will come down, because if the food one is the one that is really causing it. So if it can come down, it's of course going to be in the interest of the ordinary Nigerian. And the government is also at the same time addressing the productivity in the agri sector. I said using one stone to kill two birds. Agri contributes about 30% to GDP. And if you look at the Q3 report of the National Bureau of Statistics, the agri sector actually fell from the Q2 performance. Q2 performance, agri sector was about 1.5%. In Q3, agri sector actually fell by fell to 1.39%. So if we address insecurity, bring down food prices, okay, increase food output, you also have GDP growing. And I think doing that will help us, recover quickly from the recession, and also at the same time moderate food prices. And when that happens, of course, the ordinary Nigerian, if he has 1 naira, if he has 2 naira, that 2 naira or 1 naira can command more, command more value in terms of what he or she is able to get. So the government has a very big role to play. The central bank too, of course, has been trying in that direction, but central bank too has to do more, especially in terms of scaling up some of the interventions that it already has. The Anchor Borrower Program, is one good intervention that can also be scaled up to cover some other commodities, outside of rice. So if that is scaled up, and the interventions are also well targeted, targeted in the sense that a lot more beneficiaries can benefit, especially if the central bank can involve microfinance banks, the ones they consider strong, to be part of this on-lending, to the beneficiaries, as opposed to just using either the national microfinance banks or deposit money banks. So microfinance banks are, better positioned in my view because of their reach to ensure that a lot more people are involved. So I think doing those will go a long way in positioning a lot of Nigerians for the for 2021.
Now, Prof, I know you've spoken about all the things that the federal government, the central bank should be doing. But with all that has happened this year, what is your outlook for the capital market in 2021?
Yeah, it all depends on, again, government policies, because what has become obvious now is that government policies actually shape, stock market and capital market performance in general. Of course, that is not a surprise. We saw that in 2005, for example, when the banking consolidation helped to spur the market. So if the central bank continues along this line, continues to have policies that tend to engender a low interest rate regime in the economy, and also continues to ensure that credit is getting to the real sectors of the economy, I think that will help the markets, even if it's not staying at the level that it is. At least the volatility, which has more or less reduced now, won't be there again. We've seen a lot of volatility in the market, especially when foreign investors were around, because each time the economy faced a little shock, they left, and anytime they left, the market will come down. But what happened this year, if you see the trend in market performance, the volatility in the market, appear to have reduced. So I want to see a more stable capital market next year, a more stable equities market in particular next year. And as I say, government policies will help to shape that. Another thing that will also influence that will be, well, on the external side, the oil price. Oil price, the budget has based the oil price on $40 per barrel. So if oil price stays above $40 per barrel, it will also be positive for the equities market. COVID-19 is, of course, still there. We pray that the second wave doesn't affect us as much as it did in the first instance. So if COVID-19 is contained and the oil price does not disappoint, and we back home, policies are still favorable for the market, I think the market will continue, along this path. As I said,
well, all right, Prof,
it's already high. It doesn't mean that it will continue to be high.
Mm-hmm.
But what's important is that it will be stable and the volatility will reduce.
Right, Prof. I'm afraid we've run out of time, but we would also share with your optimism of, a stable market in 2021. It's always a pleasure having you on the show. Professor Uche Uwaleke is the president of the Capital Markets Academics of Nigeria. Well, that's it on the program tonight. Thank you for watching. I'm Edidiong Iwang. Happy holidays.